You're started.
Okay. Good morning. So today we are going to continue in Chapter 3. Chapter 3 is one of those fundamental chapters to the rest of the book. So I'd say if I were ranking chapters, it would be hard for me to select between 1, 2, and 3. These are 3 fundamental chapters. I cannot emphasize enough the need to know these chapters and to go back and review. So, just a reminder about what's due this week. This week's a little bit different because it's the week before an exam. So on Saturday this week, we have the attendance quiz that covers class today, and Wednesday, that attendance quiz will become available at 5 p.m. on Wednesday as always. Chapter 3 homework is due this Saturday. Chapter 3 homework, because it covers last Wednesday and this week, expect it to take a little longer than normal. It is such a fundamental chapter, so be sure you allow adequate time for Chapter 3 homework. Then, Sunday. Sunday, we do not have a quiz because of the upcoming exam. So there's no quiz due on Sunday, no video quiz. The next video quiz is due the following Sunday. And we're going to talk about the exam on Wednesday this week. So bring any questions you have on Wednesday. I'll have a little bit of information for you. But I want you to look at the information on Blackboard. I am not going through in class all the information that's on Blackboard. I'll take questions, but if it's on Blackboard, we're probably not going to cover it in depth in class. So again, no video quiz this week because of the exam. The exam is next week, Monday, Tuesday, Wednesday. Okay. And exam information is on Blackboard. If you're registered in Section 7 or 8, you need to make an appointment with ProctorU, and that information is on Blackboard. Whichever way you're registered to the class on Blackboard, it'll release the information to you. And I'm going to follow up with an email to you this week just confirming for you, for your purposes, to make sure everyone knows where they're taking the exam. Because if you're registered for Section 7, it will not work to take it in the lab. If you're registered in Section 1, you cannot take it at ProctorU. It simply won't work. Okay, so we're just going to dig right in today. We're going to start with short exercise 3-13A. This is a really nice, fun little one. It's pretty short. It goes pretty quickly. But it illustrates an important point. We're going to be dealing with a wide range of things today. So it tells us in the problem that the company prepaid 3 years rent. So they had 3 years rent on January 1st, 2012. So the years become very important when we're talking about this. We have prepaid rent for 3 years, January 1st, 2012. So $18,000. How much rent a year is that then? $6,000, right? So down at the bottom. So to make a note before we go any further, if we paid for 3 years rent on January 1st, 2012, that's $6,000 of insurance per year, $18,000 for the next 3 years. So we paid for 2012, for 2013, and 2014. Now, when we originally paid that rent on January 1st, what we're going to do is we're paying the rent. So what happens to cash when we? Down. It goes down. So would you debit or credit cash? Credit. Okay, so this is not part of the problem, but on January 1st, we would be crediting cash for $18,000 because we're paying this 3 years rent. So January 1st, we credit cash for $18,000, okay? And when we pay this, then the debit is going to be to an account called prepaid rent, because prepaid rent is an asset, and this represents an economic benefit to us for the next 3 years. So that's what happened January 1st, 2012. Now, at December 31st, they prepare a trial balance. Now, a trial balance, just remember, a trial balance is simply a listing of all the accounts, their debit and their credit balances. And we want to make sure, the purpose of a trial balance is to make sure the debits equal the credits. And then after they did, so they had the trial balance, and then their next step was to prepare the adjusting entries, which is a big part of Chapter 3. So now we're being asked for these questions. A, on their unadjusted trial balance. So this is the trial balance they do before they do any adjusting. Nice. Yeah. That would be me, Alyssa. Okay, so before they do any adjustment at all, how much is sitting in prepaid rent at the end of the year 2012? How much did we put in prepaid rent on January 1st? $18,000. And have we done anything to it? No. So the balance is going to be $18,000, okay, on December 31st, 2012, right? Because we haven't done anything. The word unadjusted, that's telling us we've not done anything with this yet. So unadjusted, that's what we had from the beginning of the year. Okay, now, so unadjusted is before any adjusting entry. Now, B, prepaid rent, that's our asset. Now it's saying we did the adjusting entry, okay? So this adjusting entry, what we're doing with the adjusting entry is we're recognizing that we used 1 year of rent, because this is now December 31st. We paid 3 years of rent on January 1st. So after 12 months, we've used $6,000 of rent, because it's $6,000 per year. So what we'll see there for B is their adjusted trial balance at the after the adjusting entry says that for prepaid rent we have $12,000 left. Because remember, on a trial balance, it's telling us how much that asset is worth right now. At the end of December 2012, we still have 2 years of rent left. So we can say, well, we have $6,000 for 2013, and we have $6,000 for 2014. But that's what it's asking. It's asking for the balance of that asset at the end of the first year. So the adjusting entry, just as an aside, when we make that adjusting entry, the adjusting entry for this rent is going to be to debit rent expense for $6,000 and credit prepaid rent for $6,000. Prepaid rent is that asset. Okay. So that's the prepaid rent. So that's looking at prepaid rent. Prepaid rent is an asset. Okay, next. What amount appears for rent expense on their unadjusted trial balance? Okay, so now we're looking for rent expense at the end of 2012 before we make an adjusting entry. What do you think it's going to be? So before we make any entries at all, how much rent expense will we have? 0. Okay? The reason it's 0 is because when we pay the rent in the beginning, we're going to debit prepaid expense, which is an asset, and credit cash. And we haven't made any adjusting entries, so we have no rent expense. An adjusting entry is when we recognize rent expense. So then after adjusting, now I'm going to ask you, so how much is rent expense after we make the adjustment? $6,000, yes, exactly. So in B or D, our rent expense at the end of 2012 is going to be $6,000. And that makes sense because we know we paid $18,000 rent for 3 years, okay? That's $6,000 per year. So after adjustment, we would see rent expense on our trial balance of $6,000. The big difference between unadjusted trial balance and adjusted trial balance is unadjusted is before we do any adjusting entries. It's simply saying, here's all our debits and our credits. Do they balance before we start? The adjusted trial balance has all the adjusting entries in it, so it's more close to final balances. But it's still, trial balance in and of itself, whether it's adjusted or unadjusted, means to get make sure our debit balances equal our credit balances. Okay. Okay, question for you guys now. The revenue principle requires that a business record revenue when the business A, receives an order from a customer, B, prepares the invoice for the customer, C, delivers goods or services to a customer, or D, receives payment from a customer. So we're looking for the revenue principle that requires a business record revenue when the business, okay, so when do we record revenue? Okay, what do you think? Delivers goods or services to a customer, she says C. Wait. Good morning, how are you?
Good, how are you?
Okay.
I think C.
You think C also? Sounds like a pretty good answer. Okay. D? Okay, receives payment. Okay. You think D? Okay. D? D? I'm getting an overwhelming number of D's now. Okay, let me go over here. What do you think up here? C? C? Okay, okay. Well, I'll stay up here. Okay, and the answer is indeed C. Good job. Okay, good gut feeling there. Okay, now, with the revenue principle, we're recognizing revenue when we deliver goods or services. Okay, that's what we're doing. We're recognizing it when we deliver the goods or services. It has nothing to do with when we receive or make payment. Okay, it has nothing to do with the cash side of things. Revenue principle says we should be recognizing it when we earn it. When we've delivered the goods or services, that's when we've earned it. Okay, so if you're online, emphasis, we had 24 out of 31 say D, which I was getting a lot in D in person. But do know that it doesn't have anything to do with receiving payment. It's having to do with when we deliver the goods or services. So this is really critical that you remember this. Okay, the revenue principle is always when we earn the revenue. And same with expense. The expense side of things, it's when we incur the expense, not when we pay the cash. Remember, cash basis is okay for individual taxpayers, but a business has to be on accrual basis, and accrual basis says we recognize revenue when we earn it, we recognize expenses when we incur that. It doesn't have anything to do with cash. Okay, another exercise. Now this one will go pretty quick. There's no numbers involved. And basically, we're identifying the accounting concept or principle that gives the most direction in how to account for each of the following situations. So what we're doing with each one is we're saying, what applies here? So for the first one, salary expense of $38,000 is accrued at the end of the period. This is A for exercise S3-6. So for A, okay, expense recognition principle. So that's we're accruing salary. We're not waiting till we pay it to recognize it. Accruing salary means that we're going to recognize the expense right now, even though we're not making the payroll cash payment until next month. We've incurred the salary expense, so we're going to accrue it. So A is expense recognition principle. Okay, B. March has been a particularly slow month, and the business will have a net loss for the second quarter of the year. Management is considering not following its customary practice of reporting quarterly earnings to the public. Now, so this is saying, they're saying, boy, March isn't so good. Let's not report quarterly earnings to the public. Okay? The principle that would be violated there or gives guidance is the time period concept. You need to use the same period of time over and over. We make quarterly reports. The SEC requires quarterly reports. We can't violate that because 1 month isn't as good. So time period concept applies for B. Oh, I went ahead. Okay. C, a physician performs a surgical operation and bills the patient's insurance company. It may take 3 months to collect from the insurance company. Should the physician record the revenue now or wait till cash is collected? The revenue principle applies there. Okay, by the way, for C, this isn't part of the question, but I want to ask you this because I've seen a question that looks like this before. A physician performs a surgical operation and bills the patient's insurance company. The physician isn't going to get paid for 3 months. So does the physician recognize the revenue today or in 3 months? Today, yes. Today is the answer, by the way. Yes. We recognize it when we earn it, not when cash is received. Okay, D, a construction company is building a highway system and construction will take 4 years. When should the company record the revenue it earns? Using the revenue principle, just as an aside, if we're doing an enormous project that takes 4 years, we're going to record the revenue over the 4 years as we earn it. So there's rules about how we recognize it. That particular construction accounting is beyond the scope of this class, but revenue principle still governs it. We recognize it as we earn it. And then finally, E, a utility bill is received on December 27th. So we get the bill from Ohio Edison December 27th. We're going to pay it when we pay bills January 10th, perhaps. When should the company record utility expense? Remember the electric bills, they're for the prior month. So if we receive it December 27th, we've already used the electricity. So we would record utility expense in December, and that's due to the expense recognition principle. Okay, so those are just real quick, those principles that are at play here. Okay, nice long question, but this is an excellent question. Okay, so I'm probably going to pause, let you guys write this down. So on December 15th, 2012, the dates are huge in this example. December 15th, 2012, a company receives an order from a customer for services to be performed on December 28th, 2012. Due to a backlog of orders, the company does not perform the services until January 3rd, 2013. The customer pays for the services on January 6th. The revenue principle requires the revenue to be recorded by the company on what date? So we have 4 dates listed there, December 15th, January 3rd, December 28th, or January 6th. So I'm going to pause for a minute, let you write down the question, and then I'll take some answers. Okay, what do you think? Okay, January 6th. So you're saying we should recognize it when the customer pays us. B. Okay, good. So, okay. Well, I guess we'll stop there. Okay, so, we go? Yes, indeed, you're absolutely right, and you knew you were on the wrong track when we started. Okay, so the answer here is when we perform the service. When the customer pays us isn't when we recognize the revenue. When the customer pays us, we recognize the receipt of cash, but we recognize, so yeah, so 90% online had it. Good. Okay. What? Good. 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 So it is when we perform the services. Okay. Oh, this is a fun one. Okay, so exercise 322A. What we have here is we have A, B, C, D, E, and F all require adjusting entries, okay? So we're going to be walking through the adjusting entries for these items, okay? And so we're going to do number 1, requirement 1 says write the adjusting entries. Requirement 2 is something we'll get to, so we'll come back to requirement 2. What we're going to do right now is we are going to work on doing the adjusting entries for what's going on here. Okay, so the first one, A, prepaid insurance beginning $400. So what that's saying to us is we started, before we did any adjustments, our prepaid insurance, what type of account is prepaid insurance? Asset, you said it, yes, yes, exactly. So prepaid insurance is an asset. That means we paid for insurance at some point in the future, past, that hadn't expired yet. So we started, before we did any adjustment, we had $400 in that asset. Then we paid for more insurance during the period, $1,200. And then our ending insurance balance should be $700. So somehow, you want to, no, you go, I'll do this. Just a second, we'll be back on just a minute. Yeah, I'm doing it. Good, okay. Huh? Okay, that's okay, I can do this. Okay, that's where I wanted to go with this. Okay, good. Everything okay? People online can hear? Can you see me here talking? Okay, so what we've got that applies in this case is beginning balance plus our payments minus what we use. That's how we end up with our ending balance. So think about what we're saying. What we start with, we add what we bought, we subtract what we used, and that'll give us our ending balance. Okay, so that's what I put up there is a great generic formula for many different accounts, not just insurance. If you think about anything you have, if you start with what you start with, or what you started the year with, you add what you bought, subtract what you used up, that's how you get what you ended up with. That's all this is saying. So now if we plug in the numbers that we're given, our beginning balance is given to us as $400. Our payments are given as $1,200. We don't know what the used is, but we know our ending balance is $700. So those numbers are all given to us in A. Now our adjusting entry should always be what we use. So that's what we need to solve for in this case. So that's what we're doing here. Okay, so $900 is the amount of the insurance we used. So we need to write the adjusting entry for what we used. So let's think about this. We're saying that we used $900 of insurance this period. So we want to recognize $900 of insurance expense. So I am going to debit insurance expense. The reason I'm going to debit insurance expense is because I know from looking at my debit credit handout, to increase an expense, I debit it. Okay? So I'm going to debit insurance expense, and then I need a credit. And what I'm doing with my credit is I want to reduce the balance of the prepaid insurance asset because I used some of it up. So what we're going to see here is we're going to debit insurance expense for the $900. We're going to credit prepaid insurance for the $900, and then just I put in there, you don't have to write the $400 plus $1,200 minus $700. I was just saying that's where I got the $900 amount from. Okay, now here's another hint for you. You say, well, that's a lot to go through to figure out that journal entry. You're going to have to do the math because you're going to have to figure out how much they use. That's pretty standard. These adjusting entries that we're going through right now, we're going to do some here. We're going to do another exercise either today or Wednesday. Whenever we have an adjusting entry in here, pretty much it's going to look the same every time you make it. The dollar amounts will change, but when you see a problem that says prepaid insurance has expired or we've used prepaid insurance, that journal entry is always going to debit insurance expense and credit prepaid insurance. So that reference sheet that you take to the exam, what would be good on there in some corner of it is to write down all the adjusting entries that we do. Here's my insurance adjusting entry. If I say to you, what's the insurance adjusting entry? You could just look on your sheet and go, oh, it's debiting insurance expense, crediting prepaid insurance. That's the entry. You just need to figure out the dollar amount there. But that is a good thing because these adjusting entries, we're going to talk about why they're the way they are. But in adjusting entry, you don't need to reinvent the wheel every time you do one. Every time you do an insurance adjusting entry, it's going to be exactly insurance expense debit, prepaid insurance credit. Okay, so just know that as we go through these can be used over and over. Okay, so that's entry A. So the next entry we have is B, interest revenue accrued. So what this is saying to us, when we see interest revenue accrued, that means that we have earned interest revenue, but it hasn't been paid to us. So this is like if I have money in a certificate of deposit at the bank. I know I'm going to receive it 6 months from now, but each month that goes by, I earn a certain amount. They don't put it in my account. I don't have it yet, but I'm owed it. And this is what we're saying, is we have earned $1,600 of interest revenue. We don't have it yet, but we've earned it from the passage of time. So what we're going to do here is we want to recognize, first of all, that we are owed interest. If we're owed interest, that's interest receivable. That's a receivable because someone owes us. So that's an asset. It represents a future economic benefit. It's cash I'm going to get. And then my other side of this, I'm going to credit interest revenue. Interest revenue is a revenue account, and we increase it with. So what we're going to see there is we're going to debit interest receivable, the asset. We're going to credit interest revenue. So interest revenue accrued, pretty easy. Just take the amount, recognize you now have a receivable. We just increased assets, and we're going to credit interest revenue for that. Okay, so the next entry down. Unearned service revenue, beginning 1,100, unearned service revenue ending 500. Okay, so what we have here, what it's telling us is that unearned service revenue, what type of account is unearned service revenue? You said it. Go ahead, a little louder. Liability. Liability. Oh, it's not going to invite you. Okay, nobody can see you because I don't have my camera on. But okay, unearned service revenue as a side is a liability account. Important to remember that. It's one of the accounts that doesn't seem to match what its title doesn't match what kind of account it is. Unearned service revenue. So this is a liability. We started the period with a balance of 1,100. The ending service revenue, 500. So what we're going, okay. So what we're going to do, and again, in parentheses, I'm just putting my work so you know it's not part of the journal entry. I just want to show you where it came from. So I'm going to take the difference between this beginning unearned revenue and the ending unearned revenue. The $600, I had to have earned $600. That's how my beginning balance goes from 1,100 down to 500. I earned $600 of it. So I'm going to debit unearned service revenue. I want to reduce that liability. I performed those services. I don't owe them to anyone now. And I want to credit service revenue because I'm recognizing that I've earned $600 of that previously unearned service revenue. And again, the 1,100 minus the 500 is not part of the journal entry. I just put it in there so we'd have a record of where we got the $600. Okay, so again, every one of these entries is a pretty standard adjusting entry. This one we're doing right now, C, that's to recognize unearned service revenue as being earned. So then we move on to entry D. Entry D, depreciation. Okay, depreciation, they're telling us it's 4,800. We don't need to memorize this entry. We just write our depreciation entry, but in very standard. We're going to recognize depreciation expense and credit an account called accumulated depreciation. Okay, now I'll wait for a minute while you write that down, and then I'll say a few things about this. Whenever you have to write a depreciation journal entry, it's always going to debit depreciation expense and credit this account called accumulated depreciation. Accumulated depreciation is a running total of all the depreciation on an asset. Now, when we buy, let's say we buy equipment, and I'm going to go away from this example for a minute. So I'm just going to make up numbers. Let's say I buy equipment and it's $10,000 and this equipment's going to last for 10 years. So what happens is every year that goes by, I recognize depreciation expense for $1,000 every year for 10 years. So at the end of the 10 years, I have depreciation expense for $10,000. Well, I mean, I've recognized depreciation expense for a total of $10,000, but what I've got is this account called accumulated depreciation. Accumulated depreciation, we're going to see a lot more of it in a later chapter. Right now, it's enough for you to know a couple key facts about it. Okay, first of all, accumulated depreciation is an account called a contra asset. I don't have that written down anywhere, but you might want to make note of it. Contra assets. Yeah, that was, okay. Contra asset, C-O-N-T-R-A, asset. A contra asset is a running total of all the depreciation to date. It's called a contra asset because it behaves exactly opposite from an asset. So an asset has a normal debit balance. A contra asset has a normal credit balance, and it's always shown with its asset. So accumulated depreciation would always be shown with equipment. Okay, the depreciation journal entry is always going to be the debit depreciation expense, which is an expense, and credit accumulated depreciation, which is a contra asset. It belongs with the assets, but it offsets the assets. And we're going to do a lot to do with depreciation in a later chapter. Right now, we have it in here because it is one of the adjusting journal entries we make. Okay, it's just spreading the cost of an asset over the asset's life. Okay, now, the next one, employee salaries owed for 3 days of a 5-day work week. The payroll for the whole week is $18,000. So what we need to do here is we need to take that $18,000 times 3/5, because we're saying that we owe it, so the end of the period is right after the 3rd day of the work week. So we're not going to pay the payroll till Friday, but when we prepare our financial statements on the 3rd day, we have had salary expense for Monday, Tuesday, and Wednesday. So we need to recognize 3/5 of that. So 3 days out of 5 days times the $18,000 gives us $10,800 as the amount of salary expense for Monday, Tuesday, Wednesday. So we will debit salary expense and we will credit salary payable. Whenever you see salary accrual, that entry is going to look like this. We're going to debit salary expense, credit salary payable. Salary expense is an expense account. We debit it to increase it. Salary payable is a liability, and we credit it to increase it. So that adjusting entry for salary accrual is always going to be debit salary expense, credit salaries payable. So every entry we do in this exercise and the other one that we're going to do looks the same whenever we do the adjusting entries. The numbers just change. Okay, and then we get to entry F. Entry F is income before income tax, $21,000. Income tax rate is 25%. Okay, so a company comes to the end of the year and they know, in this case, they have income of $21,000. However, they will have to pay income tax on that $21,000. So they go through lots of complicated calculations to figure out their taxes, but for our purposes, we're given a tax rate. So what we're saying here is $21,000 times the 25%, that's their income tax expense. They want to recognize it in the same year that they make that income. So what we're going to do here is we're going to take the $21,000 times 25%, and we'll get $5,250. We're going to debit income tax expense and credit income tax payable. Okay, so that's 322A Part A. Okay, so that was Part A, and I'm going to go back. So what we just did, this is not new stuff. This is, I just want to show you this. This is a listing of all those journal entries we just did. So you've already got them written down. But now, same problem, and now we're on Part 2. Part 2 says, suppose the adjustments were not made. Compute the overall overstatement or understatement if you don't make the adjustments. So this is saying, what if you don't do your adjusting entry? So what? What happens? Okay? So that list that I just showed you, the list, there were two of those that affected revenue accounts. So the entry we did for entry B and the entry we did for entry C both credited revenue. One credited interest revenue for $1,600, one credited service revenue for $600. So if we didn't make those two adjusting entries, we would have understated income by $2,200. Okay? Because the question's asking us, what's the impact on net income if we didn't make these entries? So I'm going through, first of all, I'm going to look for two things. I'm going to look at the impact on revenue, and then I'm going to look for the impact on expense. So impact on revenue is revenue would have been understated by $2,200, okay? So that's entries B and C. Okay, so what you've already got down, B and C, are revenue. Now, next, then what about every entry that affected expense? So entry A, entry D, entry E, and entry F all impacted expense. So if we hadn't made those expense journal entries, income would have been overstated by $21,750. All I did there was I took every expense entry that we made and added it up. So I took all four expense entries, entry A, D, E, and F, added up the total impact, and that total is going to be $21,750. Okay, so I have my revenue adjustment and I have my total of the expenses. Expenses reduce income, so if I didn't make those expense entries, my income would have been too high by the total of those. So then what we have the revenues that I just said. Revenue would have been understated by $2,200. Net income would have been understated if we wouldn't have recognized that. Net income would have been overstated by $22,750. So those were the two entries we just did. And then the net of those is, if we hadn't made the adjusting entries, we would see an overall net income overstated by $19,550. Okay, so that's 22A. So that was part 1 and part 2. The takeaway on that is those journal entries that we just walked through are pretty standard for different adjustments. So if you see an insurance journal entry, it's always going to look like that in terms of what's debited and what's credited. I would make a list of those adjusting entries. I know we have probably 2 more homework problems that have adjusting entries in it, if I recall. Okay, so true-false question now. A deferral is an adjustment for payment of an item or receipt of cash in advance. True or false? Okay, now a deferral is an adjustment for payment of an item or receipt of cash in advance. Let's talk about this. Deferring means to put off, right? So we can think of deferring. We put off. So we put off the expense recognition, or we put off the revenue recognition until we earn it. So actually this one is going to be true. Okay, the reason it's true is deferrals deal with things that are paid in advance or cash that's received in advance. So it's going to be our prepaid insurance, it's going to be our unearned service revenue. So it's actually true. Okay? An accrual is for something we haven't paid for yet. We're recognizing it before we've paid for it. A deferral is we're recognizing it at the money's first on a deferral. On a deferral, the cash comes first. On an accrual, the cash comes after the recognition. Okay, another one. Something will be increased when a company receives cash before performing the services. We think. Okay, on this one, we're thinking about, what's the most popular answer right now, Brian? C. Well, great. I'm glad. Because the answer here is C. Unearned sales revenue, that's that liability account. Okay? If we receive cash before we perform the services, we are going to have unearned sales revenue, a liability. Okay, I've got, okay, I just put this up because I want to say, does anyone have any specific questions about the exam? Please watch the information. In case you're wondering, yeah. The best way to study for it is study plan. Have you watched the video on Blackboard yet? Okay, I addressed that question in there because that's like one of the top 10 questions, but yes. Thank you for asking. Study plan in my accounting lab, and obviously reading the chapters and making an outline, knowing that, making sure you've got whatever you want on the exam reference sheet. But study plan allows you to practice the items in it. Okay, and Wednesday we have more time. But what we're going to do right now is we're going to do a pop quiz. Look at that. Okay, so we're getting up for here. So here's, I can't put my sound down. Okay, so if you're online, do not type it in yet. But don't. So, okay, so if you're online, sit tight. Brian will get to you in just a minute. If you're in person here, you need to get out of online. Okay, so if you're in person in this room, you need to take it in paper. So sign out of the room or whatever. If you're online, if you're watching this later, you can stop watching now because there's not going to be anything else on here now. So if you're online, Brian's going to give you the URL in a minute. I'm going to be passing out in fact, I am passing out the pop quiz right now. So if you're in person, you have to take it in paper. When you leave the room, you need to hand this to me. Okay, do not leave the room. I will collect one piece of paper per person. So don't leave without giving me your sheet. Everyone in here has to give me a sheet on the way out. Do not fill it out online if you're in the physical room. Yes, you can work together, use whatever resources you want on this pop quiz, but hand it to me. Make sure you write your name. If you're online, make sure you get your name correctly on it and your email address. And So I think we're good. I'm going to be at the back door. You've got plenty of time. Okay, so I'm going to go quiet now, but I'm back here, so when you're ready to leave, just hand me your quiz.